Today we will continue with chapter 3, adjusting the accounts. As you know that before we prepare the financial statements, we need to make sure that all the accounts are correct. If there are some data are missing, then we need to adjust the accounts. The word adjusting here, it means fixing, making things correct. So adjusting the accounts means that we need to do something so that the accounts will reflect the right numbers or the correct numbers before we prepare the financial statements. Now let's look at the time period assumption. The time period assumptions say that accountants divide the economic life of a business into artificial time periods. So we can divide the time into month, quarter, or year. Normally, companies prepare the financial statement can be monthly, quarterly, it means every 3 months, or yearly, or we call it annually, it means every year. So monthly and quarterly time periods are called interim period. Most large company, they will prepare both quarterly and annual financial statements. Quarterly financial statement means those statements that we need to prepare every 3 months. Now let's look at the new term here, fiscal year and calendar year. So let's look at calendar year first. Calendar year means your financial year will start from January 1 to December 31 according to the calendar, similar with your calendar. So we start on January 1 and end on December 31. Now this is different from fiscal year. Fiscal year, it means we can start at the beginning of any month and then end 12 months after that. Now this applies for some companies that, they operate according to a business cycle, like agriculture business, they have to look at the time when they plant the vegetable and then when they harvest them. So the fiscal year, it can be from the beginning of any month to the end of a month, 12 months after that. Let me give you an example. So for example, if we start on August 1, we will end on July 31. If we start on May 1, we will end on April 30 of the next year. If we start on March 1, then we will end on February 28. For our university, we start on August 1 and we end on July 31. Okay, let's continue with accrual and basis accounting. So for accrual basic accounting, it say that transactions should be recorded in the periods in which the events occur. So when the company perform a service to the customer, the company has to recognize revenues, even though they haven't received money yet. Okay, so they can receive the money after that. But whenever they finish performing the service, then they have to recognize revenues. Expenses are recognized when incurred rather than when paid. It means that whenever we use some expenses in order to generate those revenues, we have to recognize those expenses in the same period. even though we haven't paid money yet. But because we already used the expenses, then we have to record them. This is in accordance with the International Financial Reporting Standards, IFRS. Okay, so again, one more time, for accrual basic accounting, we record the revenues whenever we finish performing the services to the customer, even though we haven't received the money yet. Okay, we will still record the revenues. And expenses are recognized, or we recorded them when it incurred. Okay, when they incurred, rather than we pay money. All right. And next is cash basis accounting. For cash basis accounting, we recognize revenues only when we receive cash. And we recognize expenses. This means you recorded expenses only when you pay cash. But remember that cash basis accounting is not in accordance with the IFRS. Okay, it's not in accordance with the IFRS. Okay, IFRS say that we should use accrual basic accounting. All right. So again, one more time. For accrual basic accounting, we recognize revenues when we already perform the service. Okay, even though we haven't received the money yet. And we recognize expenses when it already happened. For cash basis accounting, we recognize revenues only when we receive the money. And we record expenses only when we pay money. Okay, so let's look at the example here. Now, assume that on August 29, Chan Company provide a service to Solina Company for $4,000. Okay, Chan Company received the money immediately. If the company used cash basis accounting, the Chan Company recognize service revenue? Now, because Chan Company use cash basis accounting, right? So we recognize revenue when we receive the money. And Chan already received the money. So in that case, we say that we have to record the revenues because Chan already got the money. All right. Now, another example is that on August 29, Chan Company pays $500 for the gasoline expense. For cash basis accounting, the Chan Company recognize gasoline. Now, you remember that cash basis accounting, we recognize expenses when we pay money. So on August 29, Chan Company already pay money. So yes, we will recognize expenses for Chan Company, $500. We have to record this as expenses. Okay, now let's look at another example. On August 29, Sambat Company provides a service of $5,000 to Namtip Company. Sambat Company expects to receive the money next month. So Sambat already performed the service to Namtip, but it has not received the money yet. $5,000 is going to receive next month. And Sambat used accrual basis accounting. So on August 29, should Sambat record the service revenue? The answer is yes. Sambat should recognize the service revenue because according to accrual basic accounting, okay, if the company already performed the service to the customer, even though they haven't got the money yet, we still have to record the revenues. Okay, we have to recognize the service revenues. All right. Okay, so let's continue. So let's look at the revenue recognition principle. The revenue recognition principle say that we recognize revenues in the accounting period in which the performance obligation is satisfied. It means that we record revenues in the period when we already perform the service. Okay, so you can see the picture here. At first, customer requests the service. Okay, then you perform the service to the customer. The customer promised to pay you back later. Okay, so after that, you will receive the money later. So when do we record revenue? We record the revenues when we already performed the service. Okay, revenue is recognized when performance obligation is satisfied. Now let's look at expense recognition principle. We recognize expenses in the period in which they make effort, consume assets, or incur liability to generate revenues. All right. So we recognize expenses when we use them in order to generate revenues, even though we haven't paid money yet. Okay. Whenever we use some expenses, okay, in order to generate some revenues, then we have to record those expenses. For example, if you use utility services like you use electricity, water, telephone, in the month that you generate revenues, you have to recognize those expenses, even though you haven't paid money yet. And also you hire a company to deliver the products to the customers. So the company that you hire already deliver the products to the customer. Okay, you already use their service. And even though you haven't paid money yet, you still have to recognize this as an expense. Or when you use the advertising service of another company, okay, then we have to record this as an advertising expense, even though we haven't paid money yet, okay, but because we use the services, we use them, okay, or we consume the assets like supplies, then we will have to recognize supplies expense. So remember, we have time period assumption that the accountants divide the economic life of business into monthly, quarterly, or yearly. Okay, and remember revenue recognition principle. We recognize revenues when we already perform the service to the customer, when we already sell the products. We recognize expenses when we already use the expenses in order to generate revenues. And this is in accordance with the IFRS, okay? Now, let's look at the adjusting entry. Okay, why we need to do adjusting entries? Is this because sometimes when we record a transaction and we need to make sure that the revenue recognition and expense recognition principles are followed? Before we prepare this financial statement, we need to make sure that all the accounts are correct, okay? And the trial balance sometimes may not contain up-to-date or complete data. So we need to make some journal entries to make sure that the trial balance will be up to date, or it includes complete data. All right. So normally the adjusting entry will include one income statement account and one statement of financial position account. Okay, so adjusting entry are necessary because we need to do that to make sure that our accounts are correct before we prepare the financial statement. All right, and we need to do that We need to do adjusting entry. We need to record adjusting entry every time, okay? The company prepare the financial statement. Before they do the financial statement, they have to record adjusting entries. So there are two types of adjusting entry that we have, deferrals and accruals. Now today we're going to look at the deferrals. Deferrals includes the type of accounts like prepaid expenses, unearned revenues, and so on. And accrual include accrual revenues, accrual expenses. I'm going to explain more about this later, okay? Now let's look at the journal entry, adjusting journal entry. So for prepaid expenses, when we prepay for some expenses, ahead of time. For example, if you prepay for the rent 6 months in advance, we're going to have a prepaid rent. Okay, prepaid rent. Or if you prepay for insurance 1 year in advance, we're going to have prepaid insurance. So in chapter 2, we learned that when we prepay for some expenses, before we use them, okay, we're going to have prepay expense, prepay insurance, prepay rent, and these kind of accounts is they are belong to assets, okay? They are assets account because prepay insurance or prepay rent give you the benefit in the future, okay? So when we pay for some expenses ahead of time, okay, before we use it, we will debit prepaid insurance and credit cash. All right. Now that is for January 1 when we pay for some expenses before we use it. So at the end of the year, we have to prepare adjusting entry. What will be our adjusting entry? Our adjusting entry is that we're going to debit the expense and credit prepay something. So if it's insurance, then we will debit insurance expense and credit prepay insurance. This is when we use the expense, okay? When we use the expense. So January 1, we haven't used them yet. But December 31, we already used the expense for 1 year. So now our expense increase, we debit. Prepay expense will decrease. Why? Because the benefit that we will receive in the future will go down since we already used them, okay? So we credit. Now, let me give you some example. On March 1, David paid for 12-month insurance in advance for $1,200. So David paid for insurance, an expense, in advance for 1 year, for 12 months in advance. Okay, so on March 1, that we learned in chapter 2, we're going to debit prepay insurance. And we credit cash because we pay money. Okay, so the insurance would be 100 per month, right? 1,200 for 12 months. So it's going to be 100 per month. Okay, now at December 31, so it has been how many months already gone? 10 months already gone, right? March, April, May, June, July, August, September, October, November, December. 10 months already gone. So for March 1 until December 31, we have used the insurance for 10 months. So you have to prepare adjusting entry at the end of December 31. So we're going to debit insurance expense because we already used expense for 10 months. So how did I get 1,000? It's 100 per month times 10 months, and that will give me 1,000. And I will credit prepay insurance for 1,000. Okay, let's look at another example. Okay. Simon pays 6 months rent in advance for $600 starting from October 1. So what will be your journal entry on October 1? When Simon pay 6 months rent, he pay for rent expense ahead of time. Okay. So now on October 1, we learn in chapter 1, we learn in chapter 2, we will debit prepaid rent 600. And since we pay money, we credit cash 600, right? Okay. Now is December 31. So from October 1 to December 31, there are 3 months that we already used the rent. Okay, so we need to do the journal entry for that. So we will debit rent expense. Okay, we debit rent expense for 300 and credit prepaid rent for 300. Okay. All right, now next, let's continue. Okay, when we buy the supplies, okay, we will debit supply and credit cash or accounts payable. It depends, okay? If you buy supplies on account, we credit accounts payable. But if you purchase supplies for cash, you credit cash. So we debit supplies, credit cash or accounts payable. And so at the end of December 31, when you use the supplies, you will debit supply expense and credit supplies. Debit supply expense and credit supplies. Why? Because we already used the supplies for 1 year. Okay. So we will have a supply expense increase. And our supplies and assets, right? Since we use it, our supplies will decrease. So we credit supplies. All right. Okay, let's look at the example. So on July 15, Marcus purchased $700 supplies for cash. All right. So what will be the journal entry on June 15? We debit supplies for 700 and we credit cash for 700. Okay, debit supplies for 700 and cash we credit 700. Now on July 31, Marcus went to the warehouse and counted supplies. And he discovered that supply on hand is 200. Okay, so July 31, Marcus went to the warehouse. He counted the supply and then he found that we only have 200 left. Okay, so how much supplies that we already used during June 15 to July 31? So the companies already used the supply for 500, right? So the adjusting entry will be debit supply expense for 500. This is for July 31. And we will credit supplies for 500. Okay, debit supply expense 500 and credit supplies for 500. All right. Okay, now let's look at the example here. Okay, Yazici Advertising purchase supplies costing 2,500 on October 5. And at the end of the month, an inventory count at the close of the business on October 31 reveals that we have only 1,000 supplies on hand. So how much supplies that we already use? Beginning, we have 2,500. Now we have only 1,000 on hand. So it means that we already used 1,500 supplies. So the adjusting entry to record the supply expense that we use would be debit supply expense for 1,500 and credit supplies for 1,500. Okay, so for this example, they give you, the Yazidi advertising expense. You remember we did that in chapter 2, and then we come up with this trial balance. But there's some more data that they give to us now so that we can prepare adjusting entries before we prepare the financial statement. Okay. All right. Now let's look at the next one is depreciation. Okay, so adjusting entry for depreciation expense is that we debit depreciation expense and credit accumulated depreciation. Okay, debit depreciation expense and we credit accumulated depreciation. This is for, we will enter here whether it's this building equipment or machine. Now, what is depreciation expense? You know that whenever we use some building equipment, motor vehicles, those assets, we call it land equipment, land property equipment. So these are assets, the value of the assets will not be the same, okay? After you use it, the value of the assets will go down because of the depreciation. All right. So the depreciation is the process of allocating the cost of an asset to expense over its useful life. So it is a decrease in value of the assets. So we're going to estimate them and we will allocate this depreciation to the cost of the assets over its useful life. Okay. For example, if you buy an equipment that costs you $1,000 and it has a 5 years useful life, all right? So, for the depreciation expense, um, it's going to be allocated in 5 years, okay? So the first year, your equipment will depreciate by 200. Now, how did I find 200? It's because 1,000 divided by 5 years. So the first year is going to be depreciated by 200. Depreciation expense is 200. Now let's look at another term called accumulated depreciation. Accumulated depreciation is when you add up the depreciation expense, okay? Every year is called accumulated depreciation. So at the end of the first year, your accumulated depreciation is 200, okay? 200. And then the book value, okay? Book value of the assets at the end of the first year would be 800. Now, there's a formula to calculate the book value. So the book value will be equal to original cost of the assets minus accumulated depreciation. So original cost of the assets is 1,000 and we minus accumulated depreciation 200 and that will give you 800. Okay, so book value of the assets at the end of year one would be 800. Now year two will depreciate another 200. So accumulated depreciation. Remember, accumulated depreciation is the adding up of depreciation, okay, every year. So how did I get 400? It's because we add up the depreciation expense of year one plus year two, and that will give us 400. So at the end of year two, we already depreciated 400. Okay, this is called accumulated depreciation, adding up. Okay, and how about book value? So the book value will be equal to the original cost, which is 1,000, minus accumulated depreciation at the end of year two is 400. So book value will be 600. Okay, and then year three is going to be depreciated by 200. Okay, so accumulated depreciation will be 200 plus 200 plus 200, that will be 600. And book value will be 1,000 minus 600, that will be 400. So for year four, another 200, accumulated depreciation will be 800, and book value will be 1,000 minus 800, that will be 200. And finally, the last year, we depreciate 200, and accumulated depreciation will be the whole 1,000. And at the end of 5 year, book value become 0. Okay? So how do we report the accumulated depreciation in the financial statement? You remember the statement of financial position? So we're going to have assets, right? Cash, we have account receivable, supplies, inventory, okay, so on. And then when we come to equipment, we're going to report the equipment. This is year 2020, yeah, at December 2020. Okay, so equipment will be 1,000. This is original cost. And at the end of year one, you remember at the end of year one, our accumulated depreciation is 200, right? So we put here 200. Then my book value would be 800, okay? Now, accumulated depreciation, what kind of account is that? Is that an asset liability or owner's equity? The answer is it's an asset, but it's called contra assets account. Why contra assets account? Because accumulated depreciation is make the equipment value going down, right? So we call it contra assets account. Contra assets account, and the normal balance is credit. Okay, the normal balance for accumulated depreciation will be credit. Why? Because it's decrease the assets account. Equipment is an assets account, and it make equipment going down, right, to 800. So we call it contra assets account. All right. So what will be your adjusting entry for depreciation at the end of year one? Your adjusting entry will be debit depreciation expense, right? Debit depreciation expense 200, credit accumulated depreciation equipment for 200. Now let's look at the example here, okay? For Yazzie Chic advertising, assume that depreciation on equipment is $480 per year or $40 per month. So every month you see that we will depreciate the equipment for 40, right? So the journal entry at the end of October will be debit depreciation expense 40, credit accumulated depreciation for 40. Okay, and remember, accumulated depreciation is a contra assets account. So the journal adjusting entry will be depreciation expense. Again, debit 40, accumulated depreciation equipment, we credit 40. And then we will process into the T account or the lecture here. Okay. And on the statement of financial position, we will put the book value, we will put the original cost of the equipment 5,000 less accumulated depreciation of equipment 40. So at the end of the year, the book value of the equipment will be 4,960. Remember, the formula to calculate the book value is that we take the original cost minus accumulated depreciation of the equipment. All right. Now let's go to the last one for deferral. So for the deferral adjusting entry, the last one would be unearned service revenues. Now, do you remember unearned service revenue? It happens when we receive the money before providing the service. We receive the money before providing the service. So we will debit cash and credit unearned service revenue, right? On January 1. You got the money from the customer in advance before you provide the service. So we have unearned service revenues because we owe them a service. This is a liability. So we debit cash, credit unearned service revenues. Now let's assume that 1 year already gone. Now we are at December 31. Okay, so assume that we already performed the service to the customer. Then we now debit unearned service revenue and credit service revenue. Okay, debit unearned service revenue and credit service revenues. So let's look at the example here. Okay, so let's say that on August 15, Company L received 6,000 for repairing computer service in advance, and Company L will perform the service from September to December. So on August 15, the Company L got the money, but they haven't done any repairing service yet. They got the money in advance. They will perform the service from September to December, okay? So on August 15, we got the money, but we haven't done any service yet. So journal entry will be debit, cash, 6,000. We credit unearned service revenue, 6,000, okay? Debit cash, we got money. Unearned service revenue is a liability account. We credit 6,000 because we owe them a service. Now, let's say now we are at the end of October. So how many months that we already performed the service? Okay, it will be September, right? The 6,000 is for the service from September to December. So September, October, November, December for 4 months. So 6,000 is for 4 months. Okay. Now, if 6,000 is for 4 months, then how much it will be for 1 month? Okay, it's 1,500, right? So if 1,500 is for 1 month, 6,000 is for 4 months. So 6,000 divided by 4 is going to be 1,500 for 1 month. So we are at October 31. So the company already performed the service, let's say on September and October, 2 months. Okay. So our adjusting entry will be we debit unearned service revenue 3,000. It's because 1,500 times 2. Okay, 2 months. And then we credit service revenue because we already performed the service to the customer. Unearned service revenue decrease because we don't owe them 3,000 service anymore. We already performed the service to them. Okay. All right. Let's continue with so there's many kind of unearned service revenue. As you can see, it can be the unearned rent revenue, unearned ticket revenue, okay, or unearned subscription revenues. Now, normally for the rent, right, you will pay for the rent in 6 months advance, or when you buy the ticket, air ticket, you pay the money in advance before you use the service, right? We will receive the money in advance before we provide the service to the customer. So if you are a news company, you will receive the subscriptions of the magazine in advance. Okay. So these are the examples of unearned revenues. Okay, now let's read the example here. Yazici Advertising received 1,200 on October 2nd from Anok for advertising services expected to be completed by December 31. Unearned service revenue shows a balance of 1,200 in the October 31 trial balance. Analysis reveals that the company performed 400 of services in October. Okay, so did you see that they on October 2 they received 1,200 in advance. So on October 2, we have a transaction that we debit, cash, credit, unearned service revenue for 1,200. Okay. Now is October 31, and they say that the company already performed $400 of service. So we will debit unearned service revenue for 400, credit service revenue for 400. Okay, because we already performed the service. All right. And so after we record the adjusting entry, we post them to the T account. Okay. So that is the adjusting entry about deferrals. We're going to continue with the next video about adjusting entry for accruals.